This is Justin Pulitzer. This is my weekend review video for Sunday, August 15th, 2016. Going to start out in the 7 market keys, run in a little bit into the Fed keys, cover the major market indices, some of the momentum stocks that are commonly batted about on the stream, get into some of the, earnings plays that were this week, and that will be a wrap. So let's dive right in here. We'll start out with the VIX. So I want to start the video out with something I don't usually do. Someone had asked me, one of my followers had asked me to comment on a tweet or what have you by another trader. As a rule of thumb, I don't like to do that because I don't know what is in the mind of the other traders. I can only attest to my work and my views of the market and don't want to spend my time parsing views of other people. And frankly, I don't usually care what other traders have to say or think about anything. If anything, it just gets in the way and interferes with my own work and my views. There's the common example on the internet that a lion doesn't care much what a sheep thinks. There are no sheep on the continent of Africa, so I always say a lion doesn't care what an antelope thinks. But for the purposes of this, the question was, when VIX is low, it's time to go. When VIX is high, it's time to buy. So I'm going to interpret this as meaning that this trader believes that when the VIX is low, you should be selling out your long positions, I would assume in stocks. And when the VIX is high, meaning it's time to buy, meaning when there's fear, you buy when blood is in the street. So I guess this is sort of a VIX version of buy low, sell high type of thing. So I don't agree with this tweet necessarily for a few reasons. One is that the VIX can stay in a low period of time for a considerable amount of time here. You can see choppy in a range, but low. And we can be in a time period like that. I guess you do get these momentary spikes, and I always say that when VIX is in this low range here, we're in purely directional play, meaning call spreads or put spreads or just outright calls or puts. The one thing that really concerned me with this tweet here is that I know a lot of people, no matter what I tell them, can't lay off the drugs. They can't lay off the weekly options, being long the calls or the puts. I've explained in the past that this means that you have to be correct immediately, and first of all, you have to be correct directionally and correct immediately because of the time decay. So let's unbox that here for a second. If you were to buy calls, let's say in a situation here where the VIX is exceptionally high, and then even if the stock goes in your direction, but you get a VIX collapse, you may still lose money on the trade because of the vega in the options pricing model, meaning the volatility recedes so much that even if you get a move in your direction, you may still lose money because the juice that is in those calls there would flatten out. Of course, the best way to mitigate that is to use spreads, because the option you're short in that instance also gets crushed, and that mitigates some of the vega issue. But I think that this was a little bit too cutesy. I prefer the buy low, sell high. You know, I'll take that even one bit further. You know, when you set up your trade, you should have a price goal in mind, and then start taking profits accordingly as you get into those and keep trailing stops. So yeah, I guess that was a cutesy tweet, but it's a little too nuanced for me. And like I said, you can have periods of exceptionally low volatility and stocks continue to rise. So we'll leave it at that. A couple of other things that I would say while we're on this train of thought disturbed me. I was looking through some of the polls that I do. I've been doing more and more of these polls on Twitter. I find them quite interesting, and I often use the results to do the opposite. Or sometimes the exact way that the poll goes. It just depends on my my view. I've often talked about the way stocks move, particularly on earnings, have a lot to do with the inventory going into those stocks. So that's when I do a poll, and most people are, let's say everyone's bullish, maybe I'll flatten up or I'll take short position, or if everyone's bearish, then I think something can go higher. I often note as well as if everyone is correct and the stock does go in that direction, usually there's some profit taking because all of these people are loaded up in these weekly calls and need to book their profits. So that's one way I use the polls. One of the things that disturbed me the most this week was I ran a poll, and I'm going to get into this a little bit more on Periscope. I just want to touch on this briefly. I find it interesting, though, for the market keys. I asked, when entering trades, how confident are you that the trades they'll be winners, basically. Most people answered. 43% were mostly, and 12% were extremely. However, somewhat and hardly were at 29 and 16. If you aren't ready or don't think you're entering a trade that's going to be a winner, just don't do it. And honestly, if you're not up to the point in your trading that you're confident that when you put trades on that they will be winners, what are you doing? You shouldn't be doing anything. If you're still kind of hammering it out, do it in paper or money. I understand that a lot of people like to gamble and kind of just roll the dice and see what comes. My advice to those people is just don't. If you're not confident, mostly confident or extremely confident, my answer to that question, by the way, was extremely confident. When I enter a trade, I always go into trades thinking they're going to be winners, and if I don't, honestly, I don't take them. Or I do it in much smaller size. So if you're not answering mostly or extremely, just don't do the trades, and maybe take some time out and hammer out your strategy to get a little bit better. Another one of my polls that concerned me a little bit was what's currently the biggest factor for the S&P and the SPX, and this gets directly into the market keys. The options were U.S. dollar, U.S. Treasuries, oil, or European banks. 26% people answered the dollar, 9% of people answered Treasuries, 51% of people answered oil, and the European banks were 14%. Congratulations, most of you are wrong. The correct answer to that question is, in fact, U.S. Treasuries, and only 9% of people answered that. The reason why the market is up so much is the Fed. We've all talked. I don't know how. It's on TV all day long. I talk about this in my videos in my stream most of the time. The reason why the stock market is up is because of DCF valuation and lower than normal interest rates, lower for longer. The bonds are the factor. People are forced into risk assets, and that's the reason the market is so strong. This again goes into time frame, and I put up a tweet last week, and I said about if you're running your account based on 5 and 15-minute charts, you're running your portfolio wrong. You're going to probably blow up your account. Please think a little bit more outside of just the next to last 15-minute bar. Yes, oil is a huge factor intraday with algorithmic trading. Yes, I can see that I probably could have put put more of a time frame on the question, the phrasing. But what I said, what is the biggest factor? The biggest factor is always the treasuries. So even if you're thinking, he should have specified time frame, the biggest factor is always treasuries. So that, just so you know, that is the correct answer. Yes, intraday and from day to day, oil is a huge factor within the S&P because the algorithms trade on it. But the biggest factor, meaning why the market is at all-time highs, is treasuries, lower for longer, ZIRP, basically. Anyway, that's just some good housekeeping. I'm going to get into more of that into Periscope this week, but I wanted to get that done. Anyway, here we are. I talked about the VIX, lower end of range, purely directional play. I would not be selling premium so much down here. I'd be looking to play either, like I said, if you're looking, if you want to be a bear, buy puts, buy put spreads. If you want to be a bull, do calls or call spreads. The volatility is pretty cheap. The stochastics are starting to bend back up. You can see, though, that often just winds up being a little bit choppy. I don't necessarily know that if we're just going to explode higher. Last year, roughly around this time, is when VIX bottomed. Could be the same thing again. We'll have to see. I don't assume just because something happened last year that means it has to happen again. Within the complex here is the dollar, can see we're still contained within this range. I drew there's a down channel and an up channel, and we're sort of within we're in an up channel within a down channel, if that kind of makes sense. I'll keep it simple. If the dollar can stay below 25.23, it's kind of okay. If we start getting above the downtrend line, breaking the last high, which stopped to the tick at 25.23, just to show you how accurate that level is. If we start getting above there, that's going to get people not happy. That, I believe, will start getting the chatter, the kind of the circular reference going. If the dollar is rising, who knows what is the Fed going to raise? And the crazy part, though, is that as the higher the dollar rises, people will say it's likely, it seems that the Fed is going to raise, but the higher the dollar actually goes, it's going to probably want to discourage the Fed to raise, because more hikes would exacerbate the problem, and we all know the Fed is worried about the dollar because they've explicitly said so in their past meetings, press conferences, and statements. So just keep an eye on this dollar. If it starts exploding past this 25.23, the market will not like that. The S&P will likely go lower, is my view. If it can stay tame, could kind of hang out under there, then I think we'll be okay. But for you little Wayne and Drake fans, right above it is where the trouble starts. Anyway, that's the story with the dollar. The bonds, they are just in consolidation mode. This to me looks a lot like this period here, where we were in a really choppy period that kind of was on hold for the Fed. My expectation here is for this to kind of hold up, but we do know that the Fed meeting is coming up. I think Jackson Hole is when Yellen speaks, the 25th or 26th. I'm not sure which date it is. I have to look in my calendar. I didn't have a chance to do that over the weekend. But I wouldn't be surprised to see the interest rates rise a little bit and people start getting positioned. I think most people are obviously, with the strength that this has had, people are positioned that there is no hike. I don't believe that there's going to be a hike. Bullard came out. He's been one of the kind of the wishy-washy ones, and he wasn't even talking about there should be one interest rate this year. He said there will be one interest rate in many years. So I honestly, I look at the data. I actually really look at it. The Atlanta Fed is still looking at 3.5% GDP growth. Wall Street consensus is a full point lower at 2.5. So to me, the Fed is sort of on the wrong side of this here, and I think they're going to have to just cut their estimates again, their growth estimates. And I think it's really hard for them to make the case to raise interest rates if growth is slowing. The job gains that have come, again, leisure and hospitality leading the way. This go-round had government, which the last one didn't, which was pretty high. Manufacturing actually and construction had a bit of a bump. I think that a lot of that has to do with the good weather. Again, though, temporary hiring was significant, and you had some retail gains, which is surprising because all of these stores are getting their snot boxes rocked. Anyway, by Amazon. But again, the hourly wage growth is what I'm looking at here. In the past, during more normalized times in the markets, you want to see what wage growth is, because once that starts really ticking up, that's when you get inflation. But I've laid out in many videos in the past that the wage growth is really non-existent, and I think technology and I guess globalism has made this so that these jobs really will never come back, and the wage growth really will never be anything of significance. If anything, I think that we are in a I often talk about that we're in a cyclical pattern within a larger down cycle. I shouldn't say down. It's really a structural down cycle, and we get these sort of like inventory bounces or cyclical bounces within the bigger down pattern. I don't see anything that has changed my mind on that. If anything, I think it's starting to get steeper as technology gets cheaper and more advanced. So that's the deal with the Fed. I do think that it's possible that there is a December hike, but I would be very surprised if they want to pull the trigger ahead of them. Would not be the right move. All right, let's continue on, shall we? The HYG is not helping the bears. All of the talk about oil topping and collapsing again and what have you That was this when oil peaked. I think a lot of the companies that were in trouble either did have bankruptcies or they were able to refinance and restructure as oil came higher. And oil really kind of was able to, I guess, kind of stabilize. And these companies that had, these higher drilling costs or what have you, were able to hedge out some of their risk in the forwards and futures market. And that's why I don't think HYG has been suffering as much as it had in this period, even though oil had been pulling back. Yeah, it does have some correction area. Like here, look, we broke the trend. It pulled back 50 MA, held like a champ, and now we're back up to it. So it seems to me that HYG is okay. If that starts getting, back below these swing lows, it's still making higher lows and some higher highs. If the pattern shifts and we start making lower highs and lower lows, then I'm going to have to revisit it and start to worry a bit. But the good news is, in that instance, is that we know the Fed keenly watches that, and we know that they will not be so happy to pull the trigger if the riskier of the corporate bonds are not doing well. Oil, we know, broke the trend. This doesn't even need to be drawn in anymore. It's irrelevant. And I had talked about that we were in a bit of a modest down channel. It got a little bit steeper. We had a 200 MA hold, a break, a failure to retest, but then basically came right back up. I would say that this still constitutes here a look below and fail. You have double bottoms here. If those were to fail, we would definitely see lower, possibly to some of the lower fibs. This stopped right above the 50% fib. I don't think that would hold it the next time, and I think we would be looking at 35s if we were to lose there. So we rebounded basically back up to the 100 MA. Oil is a little bit more challenged here. I will say this, and as long as it holds 42, 49, 42 half, it's quote-unquote okay. Back below there to me gets way more iffy. You had a outside day here. I talked about this in real time as it was happening, that you had a bearish inventory number. It looked below the day's range and wound up closing above the highs, above the prior, basically got above the prior couple of days and closed outside the range of the previous day. Next day, you had a bearish Baker Hughes rig count, and oil basically closed at the highs. And you can see it's kind of open here Sunday, and it's just kissing below the 100 MA. If this can just kind of like chop for a couple days or consolidate a bit, I think it could go a little bit higher. We are into some of these reference lows. I do think that the 50 MA and these reference lows and the channel high could be a problem. So as it comes into 45s and 46s, we want to be a little bit more careful, because I think that area will have some muscle memory from the people who kind of BTD, bought the dips here and were wrong, and they might want to start getting their money back. XLE held up like a boss, a few day pullback, and now it's back over the kind of the downtrend line, and it seems to be holding both the 10 and the 50-day moving averages. As long as this can hold the 50, it's okay. Back below the 50 gets a little bit more iffy. You can see it was struggling here. It finally got back up, a bit of a look below and fail. And here, if you can get back up above this 68.89, I think it'll retest these kind of poor highs up here. But XLE looks like it's holding all right. Exxon did what I had said. I said that this area was the area to kind of book some profits, wait for the pullback. It broke the channel. It had been down so many days that there were buyers. It kind of had its own look below and fail. It kind of rallied back up to the 100, backed off. We can see the 100 is important, both in CL and in Exxon. So I would wait until you can really see the 100 clear to feel more confident in Exxon. I do think that this sort of up channel within the bigger up channel could be, the backside could be retested just for selfish purposes. I would love to see Exxon come back down and retest the channel low and set up for a truly amazing long that could maybe be held for a while, but I don't necessarily know or think that that's going to happen. Let's keep it simple. This was the reference area, this 87.44. If it can stay above there, it's okay. If it can get back above this last swing high here of 88.89, still stronger, which would probably lead to the 50 MA, the gap fill, then the 50 MA and the backside of the old channel. test. Keep in mind that this stock had been basically coming off 52-week highs. It's very rare for something to go down and just keep going after it's been to new highs. There tends to be some type of a move back to a lower high, and then it would continue. So it seems to me that Exxon is just choppy. It's still contained within the earnings gap. A day low was 86.12. So if you start getting back below there, and this pullback low here, which was 86.01, so let's just say 86. As long as it holds 86, for any of you guys who've been watching me for a while, I talked about 86 like a long time ago being a really significant number in Exxon. This might have even been a year ago. It still is. So 86 is the number. If it can hold above 86 and stay above 87.44, it's okay. Back below there, I think we would see the 83. First of all, we'd see the 200 MA in the 84s, maybe even 83s. And if it gets real iffy with the market, we could even see 81s again. So the 86 level is very important for Exxon, in my view. China, gotta have your China. I've been talking about this, that this pattern is looking better, that we're now in an up channel. We broke this kind of downtrend and we're in a modest up channel. And I said I thought we'd see the backside of the old uptrend. We're actually through it. Wouldn't surprise me to see this continue a little bit more. We'll have to see how that plays out. But China is looking okay. As long as it's not in crash mode, that is good for U.S. equities. When you get one of these, it's not a good situation for the U.S. stock market. Oops, I drew something in. Yeah, this could work its way up to the channel high. Wouldn't surprise me. So that's looking a bit better. BABA, I've talked about for a while that I said I thought that this stock would see 100 again at some point. I wasn't sure if it would be this time or whenever, but it looks like we're in that kind of in that home run trot for a hundo. Let's talk about levels, about if you're long BABA. I know a lot of people are, where to book the profits or maybe where even to initiate some right or right out short tests. I did a little bit of work here. Past runs in BABA, this was $37.19. This run here from this low to this high was $29.22. And from this low to this high was $26.64. So I projected those price targets here, with this being, of course, the biggest one, the $37 move to 110. Anyway, keep in mind we're coming up very low from a very low level from 73. There's a gap fill here at 98.45. We got through the 61.8. We have the gap fill we're right up to, and then there's always that first measured move, which is 99.94, then 102.52. The last one would be 110.49, and then I just did a geometric mean. Basically, instead of just an arithmetic mean, which is just to add up all three and divide by 3, which would be, by the way, 104.30 or whatever. It's really not that big of a difference in this instance. Geometric means just tend to take into account the more negative, outcomes, and I always like to be a little conservative. If you project a 1.618 fib extension from this high to from this low, that comes in here around 103.21. So I think I can with confidence demonstrate this area is probably where you want to start looking to book some profits and thinking that there could be a pullback. So I do think that there is probably a little bit more gas in the tank with BABA, but I would at the very least be looking to book some gains into some of these levels here between 98.45 and let's say 103.21 to 104. I think in that area would be a good area to maybe book, at the very least, book some profits and trail up some stops. It seems to me, though, that BABA may eventually want to retest the 120. So I would be saying that you could probably buy some dips in this stock again. You really don't want to see it get back below like 95.52 to 95.06. So 95, you wouldn't want to see it get below 95 too much. I think that would be an important level. So keep an eye on BABA. I guess if you're long, could stick with it. If it starts getting back below 95, you might want to use a stop. That's my theory on the BABA. A lot of people very excited about IBB. I think I was very clear with this that I didn't think that this breakout here was going to be the exact one to chase, because just as we had come down from the bottom here with this kind of looking like it was going to break down, now we have come up from the bottom right to the top. It is consolidating. I'm okay with IBB long, basically, as long as it holds at the very least the 200 MA. But 286.81 to 289.71, those are some key levels. It seems like it's holding. You had a kind of a look below and fail. I think IBB probably will want to maybe drift higher here. They've broken the trend, so we have to rely on these horizontal supports. 200 MA to me is the most important one, because look, where this really this breakdown came from was the 200 MA. It hasn't seen the 200 MA again since then, so it's now back through it. A retest to me would still be kind of quote-unquote okay, but if we start losing the 200, I think that this might start looking for the clubhouse to the 50 MA, and you might want to be a little bit cautious. Down there, I would be more interested in maybe selling some puts, but I'd be really watching this 200 MA to this 289.71. This area really should hold if the breakout is real. A projection from this high from here up would be to 315.55, which is roughly close to a gap fill. You can see into here. It's a little bit higher, so maybe there's a bit of an overshoot, but it's kind of like to the lower end of these range where these tails were. So I think that there will be some interested sellers at the very least up in that area. Gilead not acting well. It rallied into the print, gap down, has continued down near these lows. I've really been hoping for a flush in Gilead to kind of suck in take out all the the weak-handed longs, suck in some shorts. Maybe this gets down to one of the 50% fib of the total range, or to the 1.618 fib extension from this range projected down to 71. So I'd be a buyer down there, maybe an out-of-the-money put seller. I think that would be an attractive region. If it can hold here and it doesn't get the flush, the other way to determine if you want to be long, and I wish this would zoom in a little bit more. Yeah, there we go. You see that the earnings gap bar low here is 80.51. The kind of the bounce high here, which wasn't very much, was 81.98. If you can get back above the bounce high, then which was 81.98, and you could see 81.89 here was really important. If you can retake that area, then I think that at the very least it'll test to the gap low and maybe even into the gap. So that's my thinking. I don't really want to have much to do with this until it either goes lower. Could always do, like I said, could always do a right or right out test against 77.92. But for me, I would either like to see this break lower for the buy down at the next extension, or on firming action back over this 81.89 area. Yeah, 81. This was 81.98. So 81.98 to 81.89. Anything back above. Let's keep it the high. I like to be a little bit tough with these. 81.98. Let's keep it simple. If you can get back above the high, which were these two bars, then I think the trade is long. So that's Gilead. Alkermes down to where I wanted it. We discussed that I thought that this could see the 50 MA and maybe the channel low. You now have 3 days with holds on the 50 MA. I like right or right out long. I wouldn't quite say that this is a secure low, but it is technically bookended by two higher lows. Keep it simple, stupid. 50 MA plus is good. Below this low here, I might want to disavow a little bit, but this area, I think, is important to hold. If you lose that, then I think we could be filling up the triangle here to like 39s or 40s. But it seems to me that this stock came from like a high in the move, and it'll probably want to maybe at the very least retest the 200 MA, considering it's right near the channel low. S&P. All right, so yeah, wow, 3 years and some blood, sweat, and tears for you cash friends here. We've just been like chopping and really mulling around in this range. Let me get into a 3-year, a 9-month daily. That's a little bit more palatable. So we had a big consolidation here. You basically had a gap and go over the downtrend here. You took out the last high, and it's just kind of consolidating. A good, healthy move would have been, believe it or not, a retest of this area, and you didn't even get that. So that's why I think that this has been struggling, because it never really had the retest. I always talk about the slingshot. However, you had a multi-day consolidation and then a look below and fail. So you had 3 days basically below the 1.272. Not much time below this. What was the low here? 215.31. Not much time below there. You can see the bodies of these bars. None of them were there. It basically held, and I think that's why there wasn't interested sellers down here. And when sellers are cut off, the buyers step back in. The market has done a lot of consolidation here now for a number of weeks. You can see the 20 and the 10-day are caught up. The 50 is really not that much below. It's down near the breakout area. The 100 MA is coming up, and the 200 MA is basically down near the channel low. I'll just say this: I've done a did a Fibonacci projection here to 221.09. That was basically off of this high to the Brexit, the low projected higher. That's where I would think that maybe, this could really blow off and get to the upper channel. That's really, to me, would be an interesting opportunity for a right or right out short area. But it seems to me that this will likely get tagged. I don't know when or what the order of operations will be, but I don't think that the high for this move is in. There's really no excess. In 2007, when the market peaked before the financial crisis, there was no excess either, and it fell out of bed, and that's why I think it got so ugly. But it just seems to me that there'll likely be a little bit more of a push. It's very begrudging. These are kind of the dog days of summer, so not that much here to look at. I took the expected move for SPY for this week, which is $2.32 roughly. That would take you up to 220.78. We're down to 216.14. 216.14 would roughly be this gap fill. That's a little bit lower, whatever. So into here, basically back into the lows of these range, or basically up near the fib extension. So maybe we get it this week. Finally, we'll have to see how that plays out. I'm also on guard, by the way, for one of these, like the look above and fail that leads to a larger liquidation break. The VIX is at the lower end of the range. There's been, a reluctance to go higher. Buyers might, kind of exhaust. But for me, I really just see it like this, that there's two ways to correct. One is by time, and the other is, of course, by price, where the market, sells off. This to me looks like a beginnings of a time correction. This has spent multiple weeks here, so it just seems to me that the market probably wants to test maybe a little bit higher. IWM looks okay. Let me show you that on a longer term chart. We're basically in this chop box. It hasn't made a new high yet, so IWM is a bit of a laggard. Yeah, so it's just kind of chugging. We broke the downtrend. We're still in the uptrend, and it's just kind of grinding higher. That's really it. 10-day here was key. I guess if you want to play right or right out, you can use this pullback low here. This range, anything above 222.60 is long. Anything below 221.15, and anything that would take out the 120.58 area. Back below here, that to me would be a little bit more bearish. Yeah, that's my view. Qs, all-time high. This to me, I believe that this was a bad tick, although algorithms like to cache those levels. Well, we're right above it. We're right above this high, this high. This seems like a gap and just grind. It doesn't surprise me given the fact that you have Microsoft at almost near all-time highs. If you go back to the .com boom bust days, let me go back 20 years monthly. This is where we're back to, almost back to. Microsoft is getting close. I think that it might tag that area out. It seems to me. Also, there's a 1.5. Let me get back into more modern times, not in the Wayback Machine. If you use this range and you project a 1.618 fib extension, you can see it would be up to 62. Yeah, and there's potentially a channel high there. Anyway, Microsoft did, however, break the trend here a little bit. It is roughly holding the 10-day moving average. It wouldn't surprise me to see this just back off a little bit here and retest the 56s, but it seems like we're so close, right? I mean, I'd be very surprised if this doesn't tag out the old .com high. Apple is starting to participate a bit. This was the shake and bake for earnings. It was a gap and gap and hold, basically. You had the first day they sold it off right at this downtrend line. I had two downtrend lines drawn in Apple. This is the first one, and then this is the second one. So it was a gap above one and sort of a gap and stop at the other. But the next day, and I talked about this in the video, was strong. You basically closed up at the high, and then the following day, you had a doji that held the 200 MA, and that's really what gave me confidence to still be long the stock. The next day, we got the move that I was looking for, the move higher. However, the next day negated it. It wound up being an inside day as far as the closure, but this did get a gap fill. However, I feel like this day was just a programmatic selling day in the market. I've discussed that, and the reason I stuck with the trade, a lot of people I know got kind of washed out of it. They were long, and then they saw this, and then they were discouraged, and they got stopped out. My trade initially here was to be long against the 200 MA, and it was never violated, so I stuck with my trade. The next 2 days showed a little bit more confidence around pair, and then we got some extension higher. It just looks like it's consolidating a little bit. These 2 days were a little bit weak relative to the market. It's still holding the uptrend here, and I'm thinking that this fills the... I have alerts and stuff here. I'm sorry, it's clogging the chart, but I do think it gets this gap fill here to the 109.85, maybe even up to 111s. I remember from way back in the Wayback Machine, there was a flash crash low of 111.27, and you can see here this 111.33. Once you broke that, was really when this got kind of fugly. I'm thinking that we can test into there. Somewhere between 109.85 and 111.27 is probably where you want to look to maybe start lightening up in the trade. If you start losing the trend here, this could kind of come back down and fill the gap here to the 105s. But for now, my theory is that Apple is probably going to rally into their iPhone release. I have good trade location on the thing, so I'm doing my best to kind of stick with it. IV is really low here, so if you're long, you can buy some puts or put spreads or what have you to hedge the trade rather cheaply. I may actually do that, and if I do, I will talk about it on the stream. Facebook just doing exactly what it always does. It does this gap kind of crap and then just chop around, and then there's like the freak out to trend, and then it does it again. This time, listen, their earnings were phenomenal. They really blew it out. I've gone over why Instagram is the overall winner compared to Snapchat and various other messaging apps. It's roughly holding the 10-day moving average. This was slightly below the trend, but basically on it. It wouldn't surprise me, however, to see Facebook try to retake this high, but as of now, I'm just thinking it's this pattern. I like strangles in the trade on short dated, and yeah, I just think Facebook could chop. If the market softens up, I mean, we'll see, I think 120.79 and maybe even 116.23. 50 MA is somewhere in between there, so somewhere in that range if it really softens up. If we start taking out this high, the 124.53, I'll be thinking we retest the highs and maybe those after-hour highs in the 132s or whatever. Longer term, I'm bullish Facebook. For short term, I just think it's kind of going to be dead money chopping around. Amazon, still beast mode, holding the 10-day moving average. I've done a Fibonacci extension here to the 833.91. We're basically just riding the channel low. It's amazing to me. This is seasonally not a great time for Amazon. I just think that their business, though, their model has just, I guess everyone realized that they're the winners, It seems to me that the stock is probably going to continue to chop and grind higher. So unless you start making lower lows and lower highs, that's when you might want to revisit Amazon. I mean, I just have my fingers crossed that this thing has some kind of hefty pullback, and you get an opportunity to kind of buy into it. Netflix looks like it's trying to right the ship a little bit. This looked like it was really getting ready to break down, right? I mean, you had multiple days down here. Then there was this gap up, I think, on some insider buying. I had talked about this, 92s, 93s being key, those old earnings, 93.55, 92.38. And once it got above there, look, you had this very powerful bar. The next day was a kind of a doji, more dojis, and then this big push-up to me was impressive. The problem for Netflix, though, is, by the way, I love when there's like 3 down and like 1 big up. If you can hold the 100 MA here, I think it's kind of okay. Look at how much resistance that was here. Roughly, we were trading around here, and when the gap happened below, it was below the 100 MA. So 100 MA plus, I think, is okay to be long. Below is a little more iffy. Just be wary, though, that there's a gap fill here at 98.81. You have a 200 MA at 101s. We have some old resistance at 103.88. And then, there's, I guess, more gap fill up to 108.40. But 105s to 103s have been an important area. I'd probably be a seller into there if you're long. I still think, look, it broke the downtrend. I like that. This to me is a really sloppy, messy pattern. So I don't mind being long a little bit, but I definitely think that you need to use some stops on this if you're playing it. Let me draw in a trend line. Could use this. So let's use the 100 MA and the trend line. Anything below that and the 50 really is roughly right where the trend line is. Gets real iffy to me and could be a short for a gap fill back down lower. I always consider both ends of the spectrum. Google looks pretty bullish to me. I think the problem they had was that they came up from the bottom. This was a look below and fail reversal bar here, which is wound up being quite powerful. It was a gap. It's holding. It's just chopping here with a couple of look above and fails at the old high. I like that this pattern is kind of holding high and tight. Anything within this bar, this kind of this earnings range, 103.94 down to even as low as 190 to me seems like the stock could go higher. It's still holding trend. It's above the 10-day MA. I think once these highs get taken, that this thing is off to the channel high. If you start losing these, the bulk of these days and these lows, I don't know how much lower this is really going to go. It never, during regular trading hours, tagged the 780, so I would think that level is a support down into 765.84. So if Google really does start pulling back here, I wouldn't mind selling puts like at those levels or even below those levels, because I think that this gap fill in this region will be a lot of support. So like I wouldn't mind selling puts like down by the confluence of all these moving averages. You have the 50, 100, and 200 MA roughly around 744. It'll probably be about 750 by then. So I wouldn't mind selling out of the money puts on any weakness there. Tesla has not cooperated very well for anyone at the moment. It's just chopping around. I have tons of alerts set on this. It's roughly just in range. I mean, they reported their number was not great. It was like double the expected loss, and then the stock couldn't go down. I still think the stock probably wants a little bit higher. I think the problem is that Musk has indicated that there's going to be some type of a capital raise, and people hate the Solar City deal. So if there's a capital raise, that means more stock issuance. So I think that's given the bears confidence to kind of hold tight. If this does wind up kind of rolling over, I think could see as low as the two. First of all, we have the secondary around 215. The 216 was the after hours low on the dump. So and that was roughly the 200 MA. So I think that area will be support. If that were to break, then I think we're looking at 205s. If this can break up, like particularly in a gap fashion, I think we'll see the 240s, maybe even still higher on a squeeze. But the stock has had a lot of noise. We had the master plan, we've had the Solar City deal, we had the earnings. It's just been really choppy. I think it still wants higher just because you have the downtrend break, and it couldn't. When stocks can't go down on bad earnings, I tend to think they go higher. But it is a very, very noisy name. Chipotle. This is an interesting nuanced trade. These little nuanced things that I look at. This was weird that they had reported. It went up, stopped at the 100, had this kind of doji bar, which is a little bit bullish, and then it just like completely fell apart back into range here. So this to me is a look above and fail. It oddly was to a fib level, roughly the 38.2. I would say this: if you get below these lows, I mean, it I guess would be a short down to the low, but if this were to somehow get itself back up over like 407.64, which is this kind of high, you might get a bit of a squeeze considering the 50 MA is right there. So if you were to get above the 50, I think that there could be a squeeze back to the upside. I have nothing on in Chipotle. I'm really not that interested in the stock at this moment. I would be, however, if there were some type of a flush below the lows and maybe down to the 312 area, which is the big 61.8 level. We're roughly around the 50% fib. So if there were a snap here, I'd be thinking maybe the this fib. Again, this did break a bit of a downtrend though, and it is just riding the backside of it. So I'm not really as bearish as most would be here. I think that there is some potential for a rebound, but not in the play. I would be in the play though if we were to get back up above these this hammer range for a right or right out trade, likely to the 425 level. Or if there is a snap here, I would be interested in a right or right out short below these lows because you've spent so much time there. You had the false rally, the move back down, and the longer it chops, and then if it goes, then I think that people would be interested in the short there. ACIA, this isn't a stock I follow, honestly. It's up a lot. It was an IPO this summer, and it is a monster. It's into some channel potential channel resistance, but I mean this is clear air. I'd be really surprised if this thing were to just come right back down. I took the liberty though of playing around with this earlier. Sometimes what I like to do with these is look where this would line up with like a Fibonacci level, like a 50% fib would take you to like 103. I think it's really 102 something, but because we're not right on it, 66. Yeah, so this would be roughly around the 102s. If you take this up to the 60, damn it. If you took this up to the 61.8, I mean this could be 125. This is all just purely speculative guessing. I will likely not be chasing this stock up this much. I would be interested in a move over the 98.77 if this spent like a bunch of days chopping here and then taking it. That to me would likely mean higher in the stock. But right now on day one, for me, there's a minimum of a 3-day rule. I'd love to see this thing spend 2-3 days here, maybe even a week, and then take it and set a buy stop up over 98.75. I'd be really surprised if this just fills the gap so quickly. My guess is sideways and then probably higher. That's just my opinion on how these stocks play out. And then we'll end on YELP. This one is a stock I've been bullish on for a while from much lower down into this area. I talked about I really started paying more attention down in like the 20s. The stock, it just got too cheap. I mean, it was only going to be selling for like maybe $2 billion. It was just it's a brand. I know Wall Street analysts don't understand that, but a lot of people, including myself, use Yelp. It's very, very popular. It's just been in a channel, and now you broke the channel. You see, this was the earnings gap day. The next day was a consolidation, and then the day after, go. That's what I'd be looking for in that ACIA. If it can do that, like tomorrow, doji, and then go, then I think that there's a play for continuation. It more than filled the gap here. You can see it basically had the gap filled, poor highs, and now it looks like it might want to make a play for 41s. can see that there was some reference areas down in here. This gap fill, by the way, was from a while ago, so it could be kind of ignored. But 41.80 to, let's just say, 42.10. Those were these lows, and look where this breakdown took place. I think up in here, maybe it squeezes into the 48s, but I do think that this area will likely find some sellers because it has come up so far so fast. There is an open gap fill here to 57.47. I do think that that will fill eventually, but I don't know that it's going to do it this time around. I wouldn't really be looking to target that for this move at this time. It's just, I think, just too much given where it, unless of course there's a bid, if it gets a buyout offer, that's a different story. But it's hard in my view to play for that. My guess is that this is, let's do a Fibonacci on this. Let's throw a Fibonacci on this one. How's that? Weekly chart. All right. A Fibonacci retracement, 101.75. Wow, this really stock got killed, right? All right, so yeah. You have a 200 weekly MA in the 44s. That's roughly where these kind of breakdowns were. I would be targeting first and foremost, like I said, the 41, 42, and then maybe looking for some of these fib retracements. You can see the 50% fib is roughly where this gap fill is, so I think it might want to work its way up there. But in the short term, I would be looking for these 47s and then maybe the 57s. I don't think that it's going to be such an easy, smooth path. But I do like that we're over. See, look, the 100-week MA was some support here. Then when it broke, it never got back above it. Now we're above it. So as long as you're above the 100-week, I'm gonna say long. Anything back below it to me gets a little bit more iffy, and maybe start feeling gap fillish. So I'll end it on that. But those are my upside targets for YELP. A couple of things. I wanted to get into the financials a little bit. I guess not, because we're already running late, but I'll discuss a little bit of those maybe later on the week, like the JP Morgan, the Morgan Stanley, the Goldman Sachs. We'll get into that in Periscope. Anyway, that's my weekend review. I hope you all liked it. If you did, please leave some comments. Definitely hit the thumbs up button and be sure to subscribe to the channel. That way you can get my notifications when there are new weekly reviews. Anyhow, that's my story. I'm sticking to it. Let's have a great week, and cheers.